BlackRock wants to tokenize trillions in ETFs, $5.5 trillion worth of funds potentially moving on-chain within 3 to 12 months. That sounds like DeFi 1, like blockchain finally conquered traditional finance, like the revolution arrived. But it might actually mean the opposite, because when the world's largest asset manager adopts blockchain technology, they're not joining the crypto movement, they're absorbing it. They're rebuilding traditional finance on blockchain rails, on their terms, under their control. And understanding that distinction changes everything, because this isn't decentralization winning. This is Wall Street adapting. And when Wall Street adapts, it doesn't surrender power. It consolidates it using better technology. If you want to understand what happens when traditional finance moves on-chain without giving up control, subscribe. Because what comes next reframes the entire narrative around institutional blockchain adoption. Let's break down what's really happening here. First, let's be clear about what tokenization actually means, because the word gets thrown around like it's magic, but it's just technology. Tokenization means representing an asset as a digital token on a blockchain. Instead of owning shares of an ETF through a traditional brokerage, you'd own tokens representing those shares that exist on-chain. What does that enable? Several things. 24/7 trading. Traditional markets close. Blockchain markets don't. If your ETF is tokenized, you can theoretically trade it at any time. Fractional ownership becomes easier. You can own 0.001 of a token instead of needing to buy whole shares. Collateral usage in DeFi. Tokenized assets can be used as collateral in lending protocols, yield strategies, and other decentralized finance applications. And settlement efficiency. Blockchain settlement is near instant compared to the T+2 settlement cycle in traditional markets. Those are real improvements. They're not hype. Tokenization does change infrastructure in meaningful ways, but here's what tokenization doesn't automatically change: ownership structure, control mechanisms, regulatory oversight, access restrictions. BlackRock tokenizing their ETFs doesn't mean those ETFs become permissionless. It doesn't mean anyone anywhere can buy them without KYC. It doesn't mean regulators lose oversight. It means BlackRock uses blockchain as the back-end infrastructure while maintaining all the traditional finance controls on the front end. Think about it like this. Email moved communication onto the internet, but corporate email didn't become permissionless and decentralized. Companies run email servers with access controls, monitoring, and compliance layers. The technology is internet-based, but the system remains controlled. BlackRock's tokenization will likely follow the same pattern. Blockchain technology, traditional finance control. The plumbing changes. The power structure doesn't. Now let's talk about what this means for the blockchain ecosystems themselves. BlackRock has indicated that Ethereum will be a primary chain for tokenization. That makes sense. Ethereum has the most developed infrastructure for tokenized assets. It has liquidity. It has institutional-grade tooling. It has regulatory familiarity. But the vision includes a multi-chain approach. Assets could exist on multiple blockchains simultaneously, with bridges and interoperability protocols connecting them. That's where other chains like XRP, Solana, and others could play roles. For XRP specifically, the pitch is cross-border settlement efficiency. XRP Ledger is designed for fast, low-cost international transfers. If tokenized ETFs need to move between different markets or currencies, XRP could theoretically serve as a bridge asset. Ripple has been building relationships with financial institutions for years. State Street is working with Ripple. There are integrations being tested. But let's be realistic about what that means. XRP could benefit structurally, but only if routing design, liquidity depth, institutional preference, and regulatory alignment all favor its integration. That outcome is not guaranteed. XRP is one possible infrastructure layer among many. At present, Ethereum remains the most institutionally integrated blockchain for tokenization. Any alternative chain would need to demonstrate measurable advantages in efficiency, liquidity, security, and regulatory compatibility at scale. Stablecoins already handle most on-chain value transfer. Central bank digital currencies are being developed that could serve the same bridge function XRP targets. So while XRP could benefit from institutional tokenization, the competition is intense. And institutions will use whatever infrastructure works best for their specific needs. They're not loyal to any one blockchain. They're pragmatic. If Ethereum is cheaper and more liquid for a specific use case, they'll use Ethereum. If XRP offers advantages elsewhere, they'll use XRP there. The multi-chain future means every blockchain is competing for specific use cases, not dominance across all use cases. And that competition is decided by performance, cost, and institutional relationships, not by community narratives. Let's zoom out and examine the power dynamic here, because this is where the story gets more complex than institutions adopt blockchain equals crypto wins. BlackRock manages $5.5 trillion. Morgan Stanley just applied for a digital custody license that would allow them to hold and manage digital assets under full regulatory oversight. The Clarity Act, if it passes, would create explicit legal frameworks for stablecoins and digital assets in the US. Put those pieces together and you get a picture. Traditional finance is building the infrastructure to operate on-chain while maintaining institutional control. They're not dismantling themselves. They're upgrading their technology stack. What does that look like in practice? Tokenized ETFs that trade 24/7, but only through approved custodians and broker-dealers. Blockchain settlement that's instant, but with compliance layers that monitor every transaction. DeFi integration, but only for accredited investors and regulated entities. Stablecoins, but issued by banks and subject to the same oversight as traditional deposits. This is not the permissionless, decentralized vision that early crypto advocates imagined. This is permissioned blockchain, private chains or public chains with access controls, technology borrowed from crypto, values inherited from traditional finance. And here's the uncomfortable question. Is that a win for blockchain adoption or a loss for decentralization? Because both can be true simultaneously. Blockchain usage expands massively, but it expands in forms that replicate existing power structures rather than disrupt them. Now let's talk about Asia, because this is where the numbers get dramatic. Susan Chan, BlackRock's head of Asia Pacific, noted that Asian household wealth totals about $108 trillion. If just 1% of that were allocated to digital assets, it would represent over $2 trillion flowing into blockchain markets. That's a massive number, and it's being cited everywhere as evidence that institutional capital is coming. But let's be careful about how we interpret this. 108 trillion is total wealth, not liquid investable assets, not capital sitting idle waiting for allocation. It's the aggregate value of all household wealth across an entire continent. Saying 1% could be allocated is hypothetical. It's a calculation, not a forecast. It shows potential scale, not guaranteed flow. And even if some portion of that wealth does move into digital assets, it won't happen overnight. It will happen gradually, over years, as regulations clarify, infrastructure matures, and institutions build confidence. So when you hear numbers like $2 trillion, understand them as potential capital pools, not imminent inflows. The difference matters because potential creates long-term structural growth opportunities, while imminent inflows create short-term price expectations that often disappoint when the timeline stretches longer than anticipated. Asia is a major market. Wealth is concentrated there. Adoption is accelerating. But adoption curves are measured in years, not quarters. And confusing potential with certainty leads to misaligned expectations. Let's bring this back to the core tension. Traditional finance adopting blockchain technology is structurally positive for the technology. It validates that blockchain infrastructure solves real problems. It drives development, liquidity, and legitimacy. But it also means traditional finance absorbs blockchain on its own terms. When BlackRock tokenizes ETFs, they're not decentralizing. They're using decentralized technology in centralized systems. When Morgan Stanley gets digital custody licenses, they're not eliminating intermediaries. They're becoming the intermediaries for digital assets. When banks issue stablecoins, they're not embracing permissionless money. They're digitizing fiat under regulatory supervision. This creates a paradox. Blockchain adoption accelerates. But the ethos that originally drove blockchain development, permissionless access, censorship resistance, individual sovereignty, gets diluted. The technology spreads, the values don't. Is that bad? It depends on what you value. If you care about blockchain as a technology that improves efficiency, then institutional adoption is unambiguously positive. Better settlement, lower costs, more accessibility to tokenized assets. If you care about blockchain as a tool for decentralization and freedom from institutional control, then this version of adoption is more complicated. The institutions aren't adopting your version of blockchain, they're creating theirs, and theirs will likely be bigger, more liquid, and more integrated with existing systems, but it will also be more controlled, more regulated, and more aligned with traditional power structures. So where does that leave individual participants? If institutional blockchain adoption means permissioned systems and controlled access, what's the path for people who wanted something different? The answer is that both versions will coexist. Permissioned institutional blockchain and permissionless public blockchain will operate in parallel. Institutions will use private or permissioned chains for activities that require compliance and oversight. Public chains will continue serving use cases that prioritize decentralization and openness, and there will be bridges between them. Stablecoins might originate from banks on permissioned chains but flow into public DeFi protocols. Tokenized assets might start on institutional platforms but eventually integrate with decentralized exchanges. The boundary between permissioned and permissionless won't be absolute, but the balance of power matters. If the majority of capital and activity flows through institutional permission systems, then public chains become niche alternatives rather than dominant infrastructure. They don't disappear. They just serve different use cases for different users. This is why framing matters. If you think BlackRock tokenizing ETFs means crypto won, you might be disappointed when the tokenized ETFs look and feel like traditional finance with blockchain plumbing. If you understand it as traditional finance adopting useful technology while maintaining control, your expectations align with what's actually being built. Here's the final reality check. This isn't a crypto takeover. It's a financial system transition. And transitions are negotiated, not explosive. Traditional finance doesn't surrender to crypto. It borrows what works and integrates it into existing structures. That process benefits blockchain technology. It drives development, standardization, and scale. But it doesn't guarantee that the values motivating early blockchain adoption, decentralization, permissionless access, individual sovereignty, dominate the final outcome. What we're seeing is institutional blockchain, not decentralized blockchain. And understanding that distinction protects you from false expectations. You won't mistake institutional adoption for revolutionary change. You won't confuse tokenization for decentralization. You won't assume that because BlackRock uses blockchain, power dynamics have shifted. Power dynamics shift slowly. Technology adoption happens faster, and the gap between those two timelines is where narratives break down, because the story sounds transformative. 5 trillion on-chain, trillions from Asia, Morgan Stanley custody, Clarity Act passing, but the structure underneath might look remarkably similar to what existed before, just running on better infrastructure. If this changed how you think about institutional blockchain adoption and what it actually means, subscribe. We're here to separate technology adoption from power shifts, infrastructure upgrades from systemic change. Drop a comment if you're noticing the difference between blockchain as technology and blockchain as movement. Let's talk about what happens when one succeeds without the other. This is infrastructure analysis, not a price forecast or investment thesis. Tokenization changes plumbing. Whether it changes power depends on how institutions design and control the systems they build. And right now, they're designing systems that preserve their position while improving their tools. That's smart adaptation, but it's not revolution. And knowing the difference is what separates clear thinking from narrative-driven expectations.